Everybody, hey, welcome to this Thursday, the 30th of May. Hope you're doing well as we get ready to talk about GDP and a few earnings surprises, or should I say, dismissible things that we've got coming up. We'll talk about that and more here when Dave joins us in just a few seconds. Don't forget that in this world we live in, there are so many things that are out of our control. However, you can take control of your investment portfolio by knowing the amount of risk you have in that portfolio versus the amount of risk you should have based on your current circumstances. Give us a call, 863-382-0037. Schedule your core retirement analysis.
Clap along if you feel like that's what you want to.
Light FM. And Pharrell Williams there. Hi, glad you're with me this morning. It's 19 now before 9. Time to check in and see what Wall Street's doing to you or for you today. And after a few weeks of doing things for you, this morning they're doing things to you. Let's double check with the things that are going on with Statler Financial Services. Phillip Statler's on the line this morning. Well, yesterday was kind of poopy, wasn't it, Phillip?
It was, Dave. It was not a good day at all. All the indexes ended up in the red, and some of them pretty substantially.
Yeah, I'd call a 411-point drop on the Dow after a bad day before that, too, kind of substantial. We were down a full 1%, down 411 points. Standard & Poor's down about 0.75%, down 39. NASDAQ kind of got buoyed up a little bit. They only lost a little over 0.5%, down $99, but that was mostly because NVIDIA keeps on growing, and that kind of helps them a little bit in a price-weighted index like NASDAQ, right?
That's right. It does, and so that obviously did help NVIDIA some, or the Nasdaq some, keeping them from going down as much as the Dow did. But they were probably well, if you look at it, Nasdaq was a big winner yesterday. They were down only 0.6% compared to down 1 and down 0.75. So.
Yeah, it was not a pretty day overall, and I don't have the way of doing the math on it. I wonder what the Nasdaq index would have been if NVIDIA hadn't kept on growing. It probably would have beat the Dow in terms of dips. A lot of that they're blaming on spiking upward on federal bond yields. I mean, the 10-year bond yield was up. It looks like 5 or 6 basis points in one day. That's scaring the pants off of anybody that's concerned about corporate debt, isn't it?
Yeah, it is. I mean, because I'm looking at the 30-year, and it jumped probably about 4 basis points from when you and I talked yesterday.
Which certainly isn't helping the futures for mortgage rates either, I assume.
No, it doesn't. But the 2-year is still below 5%, though, Dave, and but not by much. And by the end of the day, it could be over if we keep at this rate.
Now, one never knows, and we don't have a whole lot of good news to report this morning as far as what goes on. We've got some government data dump figures, though. The gross domestic product second reading on the first quarter came out, and you and I were kicking it around. One of my tip sheets was saying they were expecting it to decrease to 1.3% growth in the first quarter. One of your tip sheets was saying they were expecting 1.2%. Ended up coming in at a reduction in the estimate to 1.3%, and I'm kind of surmising that we're into one of those bad news is good news cycles here, and seeing the economy not growing as fast as they originally thought, and that's pretty much a snail's pace to begin with. I got to assume that's going to maybe just cap the way the bond yields are going up. Might be good news for the market before the day is over.
And that could very well be, Dave. I mean, that is good news in the fact that we need the economy to slow down. The Fed wants the economy to slow down. They want inflation to slow down. And so the only way to do that is we've got to slow everything down. And so it dropped 0.3% from the first reading. Well, I think it's kind of good news. The question is, we still have 2 more readings to go, right? And so or at least 1 more reading to go, I guess. So the question is, does it drop even further, or do we just kind of hold where we are at that final reading?
And recognize that the 1.6% original estimate, that kind of borders on snail's pace to begin with. You don't want to slow it down too terribly much, or you start a trend in the direction of recession. But 1.3 to 1.6%, let's kind of hold with that. That'd be nice. Another indication things slowing down ever so slightly. The employment market is still hot, but first-time unemployment claims did actually go up, and it might be the first increase we've had in a while. First-time claims up to 219,000 last week, and then you add in the release of the Fed's beige book yesterday, and they're showing a generally increasingly pessimistic business attitude. They're still seeing increases in the prices on their goods and services, which is one of the indications the Fed didn't want to see. That, wholesale inflation, we saw that come out earlier in the month, and it's not what they wanted to see. So we kind of got everything indicating the economy is starting to slow down, and some of it is for bad reasons.
Well, that's true, Dave, and we continue to watch what's happening from the Fed standpoint, and as far as inflationary periods. But I think that if we look at everything as a whole, and I think what you're talking about, it really kind of helped drive the markets down yesterday, and not helping the markets at all today. We shall see when the market gets ready to open, but definitely we are looking at substantial red ink. At least on the Dow this morning. The other indexes are, they're holding their own in the slightly red category, but not near what the Dow's going through right now.
Oh, boy. And we can't even blame Boeing this time around for a change.
That's right.
They've always been a great scapegoat when the Dow goes down. Talking about the companies themselves, we've got a whole bunch of really big losers this morning, two of them right at the top of the list. I hadn't heard about Kohl's. I was looking at another one we can get to in a minute, but boy, did they swing and a miss, huh?
Kohl's really did miss big time, Dave. They lost 24 cents a share. They were expected to lose only 4 cents a share. I'm sorry, they were supposed to have a profit of 4 cents a share. So that's a 28-cent swing there. They missed on revenue by about $200 million. And so I will say that they are getting creamed this morning, Dave, to put it nicely, down 23.6% right now.
Son of a gun. I'm starting to kind of wonder whether or not Kohl's is getting a little bit of what I used to call the penny syndrome. They're kind of stuck in the middle between, are they a discounter? Are they a full-fledged department store? You can't really put your finger onto what you call them, and that's not a good place to be when you're in kind of a rough economy to begin with.
Well, that's right, and that's an interesting analogy there to pennies, and we know what happened to them. So we hope that Kohl's can stick around a little longer.
Yeah, fingers crossed. I'm a Wisconsin boy by birth, so I kind of have an affection for the chain. I hate to see them going to heck in a handbasket like that. Speaking of heck in a handbasket, Salesforce, it's something that is not a household name to the consumer, but they're another one that kind of fell out of bed with the market, didn't they?
Oh, Dave, did they ever? They really missed on the revenue number, and that's what everybody's looking at here as we get started this morning. They're looking at the revenue miss. They were able to hold pretty close to their earnings number, actually beat by just a little bit at $2.44 a share versus $2.38. But the industry and the market doesn't like that they missed their revenue number, $9.13 billion. They were supposed to come in with 9.17. Doesn't seem like a big difference, but it's got Salesforce down 16.3% this morning.
Key Rudd. I was looking at delayed quotes, had them down 15. They're even losing more than that as it goes. Interesting. You say that the revenue number is creaming Salesforce. The other side of the fence, though, Best Buy is reported, and they missed on revenue, but because they managed to make enough to be able to make ends meet, I gather they're actually benefiting this morning, huh?
Well, they are. Their stock actually rose this morning early, and I think it's still up, but they beat by 12 cents a share, came in at $1.20. Which was good. They missed on revenue by about, I'll say $100 million, Dave. Came in at $8.85 billion. going into this morning. And so they're actually trading up significantly, Dave, up almost 7.1%. Yeah. How do you figure, right?
Standards. Yeah, different standards for different industries. If you're Salesforce, you miss on revenue, you get creamed. If you're Best Buys, you miss on revenue, you go up.
Yep. Who knows, right? And then we had Dollar General. I mean, we just got a lot of retail today. Dollar General also reported, and they beat on earnings, $1.65 versus $1.57 expected. Revenue was basically in line with expectations. They are trading up almost 2% this morning.
Cool. Have we got anything else? I just saw Hormel come across my wire. They beat profit estimates again, but they missed on sales. Did you have anything beyond that that just came across my ticker a minute ago?
I don't have that one. I have one more for you. American Eagle Outfitters. We talked about Abercrombie and Fitch earlier in the week. We have American Outfitters or Eagle Outfitters come out, and not quite as good as Abercrombie and Fitch. They they missed on sales, and so they are trading down this morning 9.5%.
Boy, the swings are not small these days, are they?
No, not when you miss in retail.
Evidently not. Resetting the table, off day yesterday, and not a good one at all on some of the indexes. 45 minutes before we open this morning, what are we looking at?
Dave, right now I see some red ink. Not across the board, but pretty close. The Dow right now is down almost 0.9%, $330. S&P 500 is down 0.25%, and the NASDAQ 100 is down a little over 0.1%. We actually have a little green ink, Dave, in the Russell 2000, up a little over 0.5%. Of course, it was down almost 1.5% yesterday. On the commodities front, we've got a lot of red ink this morning. Silver is down another 2.9%. Gold is down 0.1%, and crude oil down 0.75%. Jump up and down $78.64 a barrel.
We'll take that happily. Some good news this morning, anyway. Overseas markets, the Asian Rim really went down off of our results yesterday. They were unimpressed. Interestingly, the mainland Chinese markets were the smallest losers of the bunch, but things like South Korea, the Taiwanese exchange, and the Nikkei in Japan all down by more than 1% at the close this morning. Europe is kind of interesting. They actually are slightly up this morning. I've got mostly green ink in the European community. Overall index between 1/3 and 0.5% up this morning, halfway through their trading day. Getting a retirement plan together so that I can say to heck with this and retire someday takes some planning. How do I get a hold of you to make that plan happen, Phillip?
Dave, you're exactly right. It does take a plan, and that's why I developed the core retirement design to help folks design that retirement they always dreamed of by looking at 3 core principles. One is risk. Second is taxes. Pay the least amount possible throughout your retirement lifetime. And third, make sure you have an income plan in place. Core retirement analysis. Give us a call, 863-382-0037. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 7:30 a.m. and 95.3 FM.
And hopefully back here tomorrow morning with a little better news than we start the morning out with today. I'll see you then. Fair enough?
All right, man. Have a great day.
Thank you, Phillip. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. Have a great day. Have a great rest of this week, and we'll talk to you tomorrow. Take care.